This is Equity Investor with Julia Lee.
Welcome to the show. On tonight's show, after a decade in the doldrums, Elders is finally back to paying back its shareholders. We'll pit CSL against Cochlear to find out which is a better play in the healthcare space. And in our stock in a minute, an education stock that's become collateral damage in a takeover tussle. But first, let's have a look at Elders. It delivered an interim dividend payout for the first time in a decade after reporting a lift in its first half profits. Net profit attributable to members was up by 8% to over $40 million for the first half on the back of improved margins in the company's retail business. This, of course, is a company that looks at fertilisers, agri-chemicals, animal products, and has a strong agency in livestock, wool, as well as real estate. And Sky News business reporter Leah Shanahan spoke with Elders CEO Mark Allison about the results.
Mark, thanks so much for joining us. Congratulations on a great result, just over $40 million. What's the key to the success?
Yeah, I think this is a bit of a long story from back in 2013 when we were in bad bank. We put in place an 8-point plan for the turnaround, and we brought Elders back into a dividend-paying stock last year. And so then we refreshed the 8-point plan. We said we'd grow by 5 to 10% through to 2020, and we'd do that at above 20% return on capital. And we've set the plan in place to deliver that. So it's pleasing to have the first reporting period of the new 8-point plan to be at the top of where we thought we'd be.
Yeah, I mean, you mentioned part of that 8-point plan not too long ago after the financial crisis, Elders was on its knees, basically. What have you done? What's been the key to that turnaround?
Well, I think it's the key to in 2013, mid-2013, we decided to go back. We were under takeover from Ruralco. We took the decision to reject that offer as it was quite low. We went back to being a agribusiness, a pure play agribusiness, and at that point I became chairman. And then from there we've had a disciplined financial approach to being a pure play agribusiness.
And talk us through some of the more successful parts of the business, the property business, for instance. How's that holding up?
Yeah, well, I think the key to the business now, and the reason that we can commit to 5 to 10% growth, consistent growth, not like an ag stock, over a period at a very high return on capital, is that we have multiple products and services. So we have retail, we have our fertiliser business, we have agency, we have livestock, wool, we have banking, we have insurance, we have grain. So multiple business models, multiple geographies, and multiple products and services, which gives us a diversification that allows us to give steady, high return growth.
Now, as an agribusiness, weather's forever an issue. You were actually just saying that you actually don't have a weather map in your office, so you can't let it get to you.
Yeah, well, I think this is the 7th agricultural business I've been CEO of, and way back I gave up looking at weather maps. I think for us the critical discipline is to have a cost and capital base that allows us to make good money in bad seasons and excellent money in good seasons. And so rather than going through a cycle of making losses in bad seasons, you make good money, and that's part of the financial discipline and the diversification that we've put in place.
Now, I'm interested, you're still in financial services, with a lot of scrutiny on financial services at the moment and businesses that are horizontally integrated. Elders not quite like that, but do you have any concerns about maintaining your financial services business with the spotlight around the Royal Commission and other issues around governance in financial services?
Yeah, I think some of the issues that have been coming out of the Royal Commission are of great concern. Our relationship is not directly being a bank, clearly. We have a partnership with Bendigo Bank and with Rural Bank, and on the insurance side with QBE. And we work closely with them to make sure that we meet our clients' needs.
Now, I'm also interested, there was talk this morning about acquisitions. PGG Wrightson in New Zealand agribusiness. Tell us a bit more about how closely you're looking at that.
Yeah, I think from a few years ago we said our growth could be funded with our bolt-on acquisitions, which we've announced a number. We've announced a number recently. We can fund our own growth for the small bolt-ons. If there's a larger corporate play, we would need to go to the market. Our sense is that every year that goes by we get stronger, so we've got a very stable platform now. One of the criteria for our small acquisitions is a very disciplined return on capital regime. So we have a financial template, 3 to 5 times multiple, normalised working capital, earn-out periods over a 2-year period. If there's a large acquisition, the critical point is it has to be EPS, earnings per share accretive, and there are a number of options in the market. We don't feel that we have a need to actively pursue any. We're watching all, but our sense is that we can get to our 2020 targets with our bolt-on acquisitions. If the right larger acquisition target came into place, then it would be purely financial.
I'm interested as well, there's a lot of debate around live export trade at the moment. Now, Elders actually pulled out of live export trade a couple of years ago. That you had a cattle live export trade business. What inspired that, and what do you make of the current debate? In short, do you think it's worth it for the live exporters, especially in sheep?
Yeah, I think our decision around selling North Australian Cattle Company, which was a live export company, was purely financial. So we've been actively managing our portfolio, so low ROC, highly variable businesses. In that example, we took capital from that business and put it into to one of the insurance businesses where there's steady quality growth. So it wasn't a question on live export, it was a question on the returns and the variability for our shareholders. We remain committed to the live export industry. I think and to our clients who serve the live export industry. In terms of the Western Australian issue with the live ex sheep, I mean, clearly it's unacceptable. You cannot have a situation that we saw on 60 Minutes, and no one in the industry would support that. Our sense is that we support players that have the regulatory and maintain the regulatory and legal standards that are appropriate. I think in the case in the West, the industry is now working towards ensuring that we don't get another occurrence like that, but done properly and complying with the regulatory and legal environment, live export is a good industry, and we support our clients there.
Okay, Mark Allison, congratulations, and thanks so much for joining us.
Thank you very much.
So for our viewers who are thinking of Elders, well, where to from here? It's great to see this company coming out to play a dividend for the first time in around about a decade. But are we going to see more upside? And I guess having a look at Elders, in the end, it is an agricultural company. So this is a company that has things like fertilizers, as well as livestock, access to agency livestock, real estate. So I guess in having a look at this particular business, you want to have a look at a few things. One, of course, is where the prices of some of these commodities are headed. And I guess in the area of cattle, we've had a few years where cattle prices have been relatively high, but we're now seeing cattle prices falling, and they'll probably continue to fall over the next 6 months. So that's going to be a key challenge for Elders. And of course, the other thing with agricultural companies is weather. And while Elders said that they don't even have a weather map in their office, weather is a big one. And it's a big one for Elders because April as well as May have been extremely dry here in Australia, and that impacts on things like fertiliser sales and things related to the sale of crops as well as land. So look, I think Elders is going to have a pretty tough second half given the conditions that we're seeing, that we'll probably see a downtick in cattle prices continuing, and hopefully that dry weather spell that we've seen in Australia breaks soon, because it's not only impacting on companies like Elders, but also the outlook for companies like GrainCorp, which of course rely on the volume of crop to underpin growth in its business. Let's now get you across who's buying, holding and selling. And our first set of recommendations comes to us from Gaurav Sodhi from The Intelligent Investor.
In our small cap portfolio, we own a business called Adasol, and Adasol is a little software company that makes software to train air traffic controllers. It's one of the few companies that's actually locked in with the FAA to provide the software to train simulate air traffic controllers via simulators in different airports all around the US. So it's got a really strong competitive position there, very difficult to compete with. But one of the reasons I like it is because the revenue model has recently shifted from being a licensed revenue business, where it was very lumpy and large, to a annuity business with large service revenue. So it's gone from jumping around a lot to now being a very predictably growing revenue stream. And that should change the valuation of the business. It's actually, it jumped up a long way, got past $3. It's now come all the way back, and I think it's now back in buy territory. It looks interesting again.
What's on the sell list?
Look, I just picked out InvoCare again because as the price is falling, it is starting to look more attractive. And I just want to highlight that sometimes these businesses that look very cheap on multiples can be traps. And I think InvoCare is one of these ones that can look quite attractive on historic multiples. I can't recall it ever trading at a cheaper multiple. In fact, it's really, if you're looking at historic PEs, then this is an opportune moment. I just think that's the wrong way to think about this company, because I think when a company goes through structural change the way InvoCare is, the E in the equation is going to start falling. And I think margins are under considerable threat here. So just be very careful about looking at a previously very high quality business, watching a price fall, watching the multiple contract and thinking that's an automatic buy.
That was Gaurav Sodhi from Intelligent Investor. And of course, if we are looking at InvoCare, it's a pretty morbid topic for a Monday. It is in the area of funeral services. And I guess just having a look at why InvoCare's share price has come under pressure. And I guess one of the things we noticed with InvoCare is it reached an all-time record high last year. This is also about the time Propel Funeral Services listed on the ASX. And I find that with vehicles like this, which often look at acquisitions to grow, that when you do see a competing ASX product listed on the market, that it's the end of the party and the end of the all-time record highs. And it's not just InvoCare that's experienced this. It's also companies like G8 Education, when Think Childcare came on, that spelled the end of its easy run. And of course, if we have a look across the space, Green Cross is a big one. When Australian Veterinary came onto the market, that spelt the end of its easy run as well. And I guess when there's a competing ASX product, it means when you're competing for acquisitions, that often there's, I guess, a bit more competition in terms of price, and you don't get those businesses at the cheaper multiples. And in terms of InvoCare, look, this isn't a company that you'd expect to absolutely shoot the lights out, because let's face it, you don't want to see a big spike in terms of deaths and a huge increase in spending in terms of funerals. Let's have a look at InvoCare's share price closing down today, and it's been under pressure over the last 6 months. And now to Blue Ocean's Nathan Sumasundram with his top picks.
Credit Corp and Collection House. The macro has not changed. If anything, it's got better. CommBank came out and said delinquencies are up. It just plays into their debt traders. Collection House, I think, it's had a really big run. It's bounced to about $1.50. It was trading about $1.20, $1.30. People think that's a big run, but reality is this is a turnaround story. In that sector, if you put Credit Corp, Scottish Pacific, Pioneer, Collection House, this is an underperformer in that sector, and it's still an underperformer despite its recent rounds. I think it's a roaring buy. This should be somewhere around $2, $2.50.
Right.
So there's still a lot of upside. It is in the perfect macro thematic. This is the cycle you want to buy these stocks in, and I think this is the time. Credit Corp, similar kind of thematic, but it's got the US play. They've been there for a long time. It's beginning to kick goals. And the thematic in the US, we're beginning to see delinquencies in the credit cards and the car loans coming through, plays into their cycle. I think that big growth story in Credit Corp is beginning to kick in, and I'd be buying the management around these levels. This traded up 21, 22, pulled back to about $17, $18. I think it's a pretty good buy. I'd be back in the management.
Let's get to some sells. Nathan, what are you selling at the moment?
I think in the short term, I'd be taking money out of some of the market darlings. CSL has run way ahead of itself. Treasury Wine, again in the...
Treasury Wine's, a few people are thinking along those. The last few sessions been under a bit of pressure.
It's about a week and a half ago, it ran ahead of itself. I mean, it's run now about 2.1 standard deviation premium. It's ridiculously high compared to its own very high multiples. It's quite stretched. The other one is Woolworths. Again, it's trading at over 2 standard deviation premium for a turnaround story. So there's a fair amount of turnaround in the price. So all of these stocks are benefiting from the fact that the financials are struggling, and people are trying to find stocks where they can park the money, and these are the market darlings.
Well, do people look at TWE Treasury and look at growth as well? So with Julian Beaumont from Bennelong Equity Investors, their long Treasury continue to be bullish on it. Largely, people talk about China, but he says, yeah, that's great. They're particularly enthusiastic about the US market and opening up the US market to Treasury Wine, and as a consequence, they don't see it as being overly expensive at the moment.
I think, look, all Well, CSL and Treasury for me are top quality stocks. If you're a long-term player, you sit back and wait. I think in the short term they might see a pullback because they just benefited out of the fact that there's such a big part of the market is underperforming. Woolworths for me, I think there's macro thematics that's going to come through. That's always a risky play. But I think Treasury Wine, if you're looking at long term, sure, I'm a holder. But in the short term, I think both of those will come off as well.
It's a brave man that puts a sell on Treasury Wine Estates and CSL, but Woolworths I can understand. When you see a sector with increasing competitive pressures, it's usually those players with the biggest market share, and in this case Woolworths as well as Coles through Wesfarmers, that have the biggest to lose. So it looks like Woolworths as well as Coles may be under pressure for a while yet, especially as international competition intensifies on our shores. Coming up, our stock in a minute, plus Rob's buy, hold and sell calls.
You're watching Equity Investor on Sky News Business. Welcome back to Equity Investor.
Welcome back. We have a very special guest for you, Rob Riley from RMC Capital, joining us from Perth. And at the time of recording, it was announced that IEL was going to see some changes. But first, Rob, welcome to the program. Great to see you there.
Thanks,
we want
Julia.
to start off with, I guess, my favourite segment of the show, and that's buy, hold and sell. So can we find out what you're looking at the moment, what you find interesting, what you'd be holding and what you'd be selling?
Okay, I've tried to come up with an interesting eclectic mix, I suppose. Being West Australian, I've got resources running from my veins, so forgive me if I'm a little bit talking about that topic more than anything else. But I suppose my sell is Orocobre, which is a lithium producer. I've got nothing against the company as much as I just have a belief that the lithium price is going to come under pressure over the next year or two due to the fact that supply is going to catch up with demand and surpass it. So there's lots of lithium resources, particularly in places like Chile and Argentina, that are ready to come on stream in the next couple of years, and I think the market will be swamped with new supplies, similar to what happened in the iron ore market. So that's my sell, Orocobre. My hold is AMP, and that's probably a little bit controversial, but I mean, if you held that puppy all the way down to this level, there's no point selling out now. I think the shorters have got hold of the stock and may push it down a little bit further, but I think there's quite a lot of deep value in AMP at these prices, and a lot of the bad news is factored in. Sure, they've got some credibility issues, but I think over a 12 to 18 month time frame, I think you'll do quite well holding that stock. And my buy is really, I could have picked either Rio, BHP or Woodside as my buys. Again, macroeconomically, I think the commodity prices are going to stay up for longer. They don't have to go up from these levels, they just have to stay stagnant, and we're probably we're going to see major upgrades coming in from some of these companies. All of them are looking good from a balance sheet perspective, and as I said, commodity prices are currently well above consensus forecast for analysts, and I think there's some upgrades coming in all of those.
Rob, you know I love putting you on the spot. So just coming back to your lithium sell and Orocobre, does that mean that you would have a sell on all the lithium stocks out there on the market? What about Galaxy, Pilbara Minerals? Do you expect that supply just to impact on pricing and be a dampener for all of those stocks?
Yeah, good question, Julia. And yes, the answer is yes. Really, I think from a sector point of view, you could say that all those companies will come under pressure in a 12 to 24 month period, because I think the new supply is coming. Lithium prices are at unsustainably high levels at the moment due to what has been a supply shortfall, and once new production comes on stream, all these companies will be under a little bit of pressure. Similar again to that iron ore industry that there was a bit of a bloodbath in that market about 2 or 3 years ago.
Thanks, Rob. Now it's time for our stock in a minute. This is an educational play that's waiting for its spot in the ASX 200 index. Here's Elio D'Amato from Stock Doctor.
Hello, I'm Elio D'Amato from Lincoln Indicators, the makers of Stock Doctor. IDP Education, and their code is IEL, is a provider of international student placement and high-stakes English language test services. They also run and operate English language schools in Southeast Asia, and they organise a number of educational events and conferences globally. And the company listed in 2015 and remains majority owned by some 38 Australian universities. Now, IDP is a Stock Doctor star stock. It is in strong financial health and has achieved consistent and solid earnings per share growth. Now, it is suitable for growth-focused investors looking for exposure to the increasing demand for international education, in particular here in Australia, and of course English being a global language. Now, the current outlook for the company remains quite positive, with the thirst for knowledge and the need for many international students to come to Australia remaining quite strong, and they've also got a number of corporate partnerships that they're establishing all around the world. The company is a little bit highly priced, but that's only fair because we believe that the company's outlook remains so solid that it's worthy of the premium being currently issued on that stock.
That's an interesting stock by Elio, waiting for its place in the ASX 200 index. And of course, that's important because the growth of passive exchange traded funds across the globe means that being included in the index can be a short-term boost for the stock. And if you're interested in stocks like that, on Tuesday, tomorrow, we will see the MSCI rebalancing announcement. And perhaps we'll see another Australian New Zealand stock, that's A2 Milk, being included in that index. So keep an eye on that stock as well. We hope you've enjoyed the program tonight. A big thanks to my guests tonight, Rob Riley from Perth. And a reminder, you can watch the show at any time with Catch Up on Foxtel Go and on demand on Foxtel IQ. We also have a podcast which you can find at skynews.com.au, and if you're overseas, we're available on demand on australiachannel.com.au. I'm Julia Lee from Bell Direct. Thanks for your company.
Information presented on this program is general in nature